So when I say nothing stops the train, there's actually two sides of it. One is basically the argument that they, despite multiple attempts, they will not like materially and persistently reduce the fiscal deficit. So that's one side of it.
Hmm.
The other side is kind of the other, which is to say it's also not going to blow up anytime soon, right? So it's not like it's going to spiral into disaster anytime soon. Basically, that the wheels are going to stay on the track. And so neither to the bull side, which is basically the Goldilocks scenario where they manage to get deficits down, or to the bear side that we just, hyperinflate next year or something, is basically saying that those are both very low probability outcomes in any sort of investable time horizon, 3, 5, 7, 10 years. And that therefore we're stuck in this kind of middle gray zone of large deficits, but the system continuing to run.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest has long been warning that the US, as well as many other countries, is now in an era of fiscal dominance. That's when fiscal spending gets out of control, like a runaway train. It becomes so large that it becomes the primary determinant of economic growth and inflation, steamrolling over any impact of monetary policy or private sector lending. And today's guest is famous for predicting, quote, "Nothing stops this train." But can its momentum be slowed, buying the system more time? And does AI offer a chance to improve the situation? For answers, we're very fortunate to welcome back to the program Lyn Alden, investment strategist and author of the book Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better. Lyn, thanks so much for joining us today.
Thanks for having me again. Happy to be here.
Oh gosh, it's always such a pleasure, Lyn. Um, well, you have been saying for a long time, nothing stops this train. And I think anybody with eyes looking at the system can say, yeah, so far at least, Lyn's been pretty darn right. Let me ask you this. So normally I kind of kick these off with what's your current assessment of the macro situation? And that's kind of what this question is. But let me put a little spin on it. Um, the administration has been saying, look, you guys should prepare for a really good 2026. We did a lot last year that's going to start creating tailwinds for the economy from here, and it's only going to get better, right? And of course, it's their job to be the cheerleaders in chief, but they have been doing a lot to try to spur economic growth, and we'll see whether that bears fruit or not. But is there a chance that if they are able to increase economic growth notably, that could buy us more track for the train, let's say?
Well, I mean, it's a good question. One of the factors is if you look at GDP growth, one of the inputs is the deficit, basically overall spending
Hmm.
matters. So you almost get like a feedback loop there. In general, the nothing stops this train thesis, um, basically the more productivity growth there is, the more offsets there are to the money printing, the longer it goes. So when I say nothing stops the train, there's actually two sides of it. One is basically the argument that they, despite multiple attempts, they will not like materially and persistently reduce the fiscal deficit. So that's one side of it.
Hmm.
The other side is kind of the other, which is to say it's also not going to blow up anytime soon, right? So it's not like it's going to spiral into disaster anytime soon. Basically, that the wheels are going to stay on the track, so to speak. That there is a lot of highway ahead, whichever kind of description you want to
Hmm.
use. And so neither to the bull side, which is basically the Goldilocks scenario where they manage to get deficits down, or to the bear side that we just, hyperinflate next year or something, is basically saying that those are both very low probability outcomes in any sort of investable time horizon, 3, 5, 7, 10 years. And that therefore we're stuck in this kind of middle gray zone of large deficits, but the system continuing to run. And the overall kind of inflation calculation, price inflation, it's obviously a very we've talked about this before, and your other guests have. It's a very messy calculation. There's all sorts of factors and variables that go into it. But when it's putting aside the measurement artifacts, basically what price inflation is you have, at least in the modern era, you have money supply growth. So over the long term, it might be 7% per year in a developed country. And then you have productivity growth, which is lumpy, and it doesn't affect all things equally. But over time, and we have billions of people working, we have technology getting better, we are better at organizing and doing things in the world. So that all else being equal, many things get cheaper in that kind of economic sense, but then it's
Hmm.
offset by the money printing. So if on average, the 7% money growth, but we get 4% better every year at making the average thing, quote unquote, then the net price inflation is something like 3%. Although,
Hmm.
of course, it's very uneven. And I think that's the trend that's going to continue for quite a while.
Okay. And let me just make something clear here because I could be wrong, but I think some people might look at the nothing stops this train reminders and they go to a more dire conclusion. But what I hear you saying is this train is likely to run for a good while, at least for an investable time frame. You should expect it to continue to run. So in your reminders that nothing stops this train, you're not saying, hey, there's no track out sign coming anytime soon that you see right now.
Yes, basically yes. The caveat there, the really big caveat, is that it doesn't mean it's without problems or consequences during that
Sure.
time. So people often ask, when will the deficit matter? I've been arguing it's already mattering. So literally since the late 2010s, I've been talking about how this will contribute to a period of ongoing political polarization. And that's only gotten more and more noticeable over time. And it contributes to things like the K-shaped economy or the two-speed economy, different words
Right.
to describe it.
And sorry to interrupt, but is it because of the bifurcation of the economy that you then have the political uh, turmoil, or are there other factors coming in as well from fiscal dominance?
I think there are other factors. I mean, if it was as simple as say rich people on one side and not rich people on the other side, we could say it's 100, it's caused by that.
Yeah.
There's a multitude of factors in there. I mean, they go back all the way to the fourth turning type stuff too. So some of it's not economic. Some of it is just that we built institutions that last for, maybe a human lifetime, and then they suffer from internal entropy, corruption. We lose faith in them. Generally, there has to be some sort of kind of death and rebirth cycle, or at least partial
Yep.
death and partial birth that we haven't really gone through yet. So we have very little trust in institutions. There's technology disruptions on the way we do things. There's trade imbalances that have been building for decades that
Hmm.
myself and Luke Roman and others prioritize quite a bit in our discussions. Um, there's multiple other imbalances there. The fiscal deficit is one of the larger ones, but it's by no means the biggest. But generally speaking, whenever, not just this one, but in any history, when you have fiscal dominance, when the sovereign itself is kind of like long-term structurally insolvent without basically monetizing its own debt to varying degrees,
Hmm.
that doesn't go lightly, right? The state doesn't just say, "Whoa, we just got to let it run out." I mean, that's when the state gets kind of aggressive. Then people get aggressive about what the problem is, whose fault is it? So it's one big variable among a mix of variables.
Okay. So one of the variables that you just mentioned there was trade imbalances. And I know it's hard to talk about the man, it's hard to talk about the president without people feeling like you're making a judgment call on the man. But from a strict policy standpoint, obviously that's been a priority of the new administration is to try to address some of these trade imbalances. How well do you think they're doing so far? Is this something that is as far as you can tell, net helping and to use maybe to murder our analogy, adding even further miles of track ahead to the train, or do you give them a failing grade?
So I'm on record, and I continue to hold the view that it was right for the administration to start prioritizing that. Before this administration, even though it was a growing issue, there were not that many people talking about it. Certainly, politicians. How many times did a trade deficit come up in debates throughout the 2010s, for example, and even kind of the early 2020s. Um, there are those like again like myself and Luke Groman talking about it because it impacts things a lot. So I think it was correct for them to finally say this is actually a really big topic. Now, Donald Trump as a person has been talking about that for decades.
Right.
He kind of
Since the 80s, I think. Yeah.
yeah, he moves. I mean, his opinions on any given topic is it kind of flows with the wind. That's kind of that's marketing, but that's one of his actually really consistent topics. That kind of goes against the exception of things. So he's personally had that, but as an administration, this is the right time. Where I mean, before was the right time, but it's
Right.
if earlier than later, to start really highlighting it. But I think that the mix of policies they've done doesn't really address the core issue. So just one is using emergency authorizations to impose tariffs. So generally speaking, and the Supreme Court just ruled on this. This has been ongoing for a while. Congress is supposed to be the one that does taxes. There's nuance there, um, but they've done executive orders to say, okay, it's an emergency, so we can tariff anyone, any amount for any length of time. And then they often will even cite things like, we don't like how Brazil's doing things internally, so we're going to tariff them more, which
Right.
goes
It
against.
becomes not just a immediate economic tool, but a tool of political influence.
Yeah, so it's kind of like taking something that should be on Congress and moving it elsewhere. And of course, the logistics of it is that when you do a tariff, it's the domestic importers that are paying it, and then the question is, can they pass that on to consumers, aka Americans, or can they try to negotiate with the foreign exporters for lower prices?
Right.
Most analyses, whether it's the Federal Reserve doing the analysis, they've done one, or multiple investment banks like Goldman Sachs and others do the analysis, the vast majority of the tariffs being paid by American firms and to a lesser extent consumers, a much smaller segment, the foreign sector.
Mhm.
Um, and so it's a tax increase. Now, it's a tariffs can be a tool, but when businesses have uncertainty, right? So it's like, okay, you used emergency authorization for a ostensibly permanent thing, the Supreme Court's ruling on it. Now they've ruled on it. So they've been in this limbo. Do you bring supply chains from foreign to domestic, which is very expensive, and then you have, generally speaking, they weren't here for a reason. It's higher operating costs.
Right.
And if another competitor says, well, we're going to wait this out and see what happens, right? These are all like uncertainties. So a lot of businesses say, we're just going to pause and see how things go. Um, so I mean, I don't really think that the mix itself is particularly conducive. Manufacturing jobs in the U.S. went down very slightly in 2025. Industrial production was flat. Um, there's no real major trend towards reshoring, where they be kind of expected to be. I think the best you can do in one presidential term is to start pivoting both the public awareness, the narrative, and then some of the direction.
Yep.
It's because I mean it's a multi-decade problem that built up. It's actually a very long
Right. You
problem to
can't
fix.
reshore in a year.
Yeah.
Yeah.
Um, but I think the kind of chaotic mix of things, because we're even tariffing the things we need to import to build our own manufacturing capabilities
Mhm.
is the challenging thing. So yeah, I don't view the execution as particularly elegant or effective. But I do think that it is a point that needs to be elevated more than it has in prior political cycles.
Okay, so it sounds like you're giving him credit for saying, look, this was a major issue that had basically been ignored or underattended to by prior administrations. So kudos for making it a priority, not loving the actual execution so far. Let me ask you this, Lyn, and I don't mean to really put you on the spot here, but I'm curious. If everybody watching this said, you know what, Lyn, we think you could figure this out even better. How would you be doing? What would be some of the core tenets of the way in which you would do this, as differentiated from what the administration is currently doing?
Okay, I'll answer that. The short answer is I would fail because the public wouldn't really want the pain of it right away.
Mhm.
And that's the challenge is that if you back up away from the tariffs for a second, basically that we have the global reserve currency. We run the biggest fiat ledger that most other countries tie into in various ways.
Mhm.
And that gives that ledger like an extra monetary premium. And another way of looking at it is the whole world needs dollars. How do we get dollars out into the world? The answer is we run structural trade deficits, and so dollars pour out into the world. That's the primary way that all those dollars get out there, and then that's
So
how they
that
circulate.
deficit is a feature, not a bug, is what you're saying.
Yeah. Now it comes with costs, right? So that is a necessary kind of variable in the system. If you want the whole world to use dollars, they have to have dollars to use.
Hmm.
So one is you can do swap lines. I mean, you can permanent like swaps. You could say, okay, well, we'll throw dollars at you if you throw euros at us. That's one method. It's not the method we really use at scale. And the other method is we just buy more than we sell,
Right.
and the difference is dollars just flow out in the world and they get all recycled around. Um, and that felt great in the beginning because we're like, hey, we're giving paper IOUs to the rest of the world and we're getting goods and services. This is
Right.
awesome. The downside is, then they take those dollars and then they buy our appreciating assets. They buy our corporate equity. They buy our real estate. They buy our private equity. So actually, what we're doing when you do the full accounting is we're buying on average depreciating assets more than we're selling, and we're selling percentages of our appreciating permanent capital stock to the rest of the world, with the
Yeah.
dollar just being the intermediary. Um, and the, when you say who this benefits, right? America is not one thing. It's 300 plus million people. It's government. It's businesses. It's individuals. It's different sectors. And so running the ledger that everyone uses is very good for the government up until a certain point because they get to sanction anyone they want. They can print money for strategic things, like oil. They can surveil everything. So they have the power to say, every bank that touches dollars, we need you to report to us so we can do global taxation stuff, right? Better than any other country can do. That the government loves those capabilities.
Sure.
But the downside is that because the dollar has an extra monetary premium on it, because basically everyone uses it globally, or at least every business and government uses it globally, and some individuals. It makes the dollar kind of structurally overvalued on a trade basis, which is how that mechanism forces the deficits to continue, which makes it it's a headwind against lower margin things. So in the US, we can still do healthcare and software and financial services, but we have trouble with lower margin things, which primarily
Right.
includes manufacturing, which is why all that goes elsewhere. One of the big reasons that goes elsewhere. Um, and so one of the challenges is to acknowledge that, okay, maybe that made sense when you're trying to win the Cold War, but then in this kind of global world, the fact that we're one country running this big ledger, there's pros and cons to it, and the cons are now as big or bigger than the pros. And especially if you're not the government. If you're not the government, your cons are way bigger, generally speaking, than the pros. Um, and so one of the challenging things is to say, okay, we want to rebalance trade. That means giving up some percentage of the global reserve status we have. Um, and it doesn't mean giving up all of it. Doesn't mean another currency gets bigger and takes it. It means you have a more multipolar world.
Right.
It's kind of like retreating from a position of strength. It's like when Rome says, okay, our borders are too big, there's barbarians everywhere. Instead of trying to fight tooth and nail for the next few decades to keep every border we have, maybe we can look at the map and say, okay, these are more defendable borders. We're overextended here, but we really should hold this one. And just kind of right size your borders.
Sure.
that so my policy, if I was somehow in charge of this, would be to kind of it'd be like an elegant resizing, which is to say maybe we don't need 800 foreign military bases. Maybe we don't need to be involved in every global conflict.
Hmm.
Maybe we can focus on our own backyard. Maybe we can emphasize economic vibrancy and therefore be strong in that other way.
Hmm.
Um, and to basically say, look, if China wants to use its own currency with its own trading partners, great. Stop overvaluing our currency. If countries want to stack more gold or other neutral reserve assets instead of treasuries, great. Stop overvaluing our dollar. The problem is, as you kind of gradually lose global reserve currency, or at least become a plurality, you become the biggest, but not the majority of the whole system, uh, tends to be inflationary. You have a currency devaluation. So some of the things I would do would be painful for some, but it'd be part of rebalancing the whole system. And I think it's gonna be hard either way. Like I would get voted out of office if I try to do it. I think it has to be done.
No, but that's okay. We want to hear, what is the tough medicine we need. Um, a couple questions on that. I just interviewed Brent Johnson, be the video that launches before yours, Lynn, and I pulled up a chart that he had tweeted out, and it was the percent of U.S. financial assets owned by foreigners over time. I think it started in 1990, and it's pretty much an exponential chart at this point. It's not even a straight line going up. Um,
Yeah.
and Brent obviously likes to bring that up because that's sort of a key part of his dollar milkshake theory. Is that the rest of the world, given the dollar milkshake capital, more and more capital from the rest of the world will get sucked into the U.S. If you were to do what you said needs, or the country were to do what you think needs to be done, um, would there actually be an impact on our financial markets because we wouldn't be bringing in as much foreign capital here? That foreign capital, given some of the border retreats, to use your analogy that we're using, we're sort of shrinking our sphere of influence. So some of that capital would go elsewhere. So would another knock-on effect be, it would also be inflationary, but there'd probably also be maybe more secular weakness in our financial markets as a result?
Yeah, there was a paper from Stephen Myron. It was just after Trump was elected, and he was going to be his key advisor. He was Trump's key advisor before he was placed onto the Fed for a
The
period of
Fed.
time. And he did a whole paper. It was a good paper. I disagree with parts of it, but it's kind of the steelman case for what this administration on paper was looking to do. So we talked
Hmm.
about execution before. This is kind of like the cleanest execution, at least from them. Uh, and one of their tools actually was kind of how can we discourage so much investment coming in here?
Hmm.
And one of the mechanisms you can place like it's a type of tax, um, which is to say, oh, you want to own some of our bonds? Well, we're going to tax, maybe 50 basis points of the interest that flows out to you. And we're going to keep that as kind of like the cost of
You
running this
being able to
ledger,
access our bond market. Yeah.
you being able to access our bond market and to say, and more broadly to say, and we're going to use that because part of this whole thing that is that we keep all the shipping lanes clear, or at least historically that now it's questionable, but that historically that's what we do. And it's like, okay, you want to be under our security umbrella, you want to have all your logistics be just kind of like clean and free.
Right. This is your
Um,
Costco fee for
this is
that.
your cost. And you can do it with stocks too. You can, I mean, obviously, and countries do this with dividends all the time. There's like a dividend withholding tax. And it's kind of a way to say, okay, well, foreigners are not going to get a differentiated thing than our domestic investors.
Hmm.
But yeah, you can do an extra layer and say all that stuff that's flowing out, we can place some small amount. Say, okay, well, this is the biggest, deepest, most diversified, capital market in the world. What's the point that you can kind of tax it? And that actually does affect foreigners, unlike the kind of tariffs, which are literally taxes on American importers.
Hmm.
Um, I think that's actually the smarter direction to start in than tariffs. Or you can kind of do a 1-2 punch. Um, and so it's actually that's the downside of so much foreign capital coming in, which so if again it goes back to who's winning from this. If you're, an American investor and you have a big stock portfolio, and I have a stock portfolio, from that side of me loves the foreign investment. It's like propping up the valuations of the assets I own. That's
Right.
great. It also makes it so when I travel globally, my dollar's stronger than it should be, and I get to, get things cheaper when I travel. Um, but as America has as an economic entity, going back to what I said before, when you rephrase that, we are buying on net more depreciating assets than we're selling, and we're financing that by selling percentages in our very valuable companies, public and private, as well as credit in those companies or our government, so
Yeah.
bonds. So we're selling appreciating assets for depreciating assets, which is not a good long-term trade, but this is a multi-decade trade, and there's winners and losers depending on where you are positioned, what industry you work in, whether you're a government, corporation, individual, and so forth. So my approach would kind of be the painful medicine of saying, okay, we want to be an attractive place to invest, but we want it to be because of rule of law and because of the vibrancy of our economy and free markets and things like and diversified deep capital markets. But we don't want this weird imbalance where the whole world has to use dollars.
Hmm.
Therefore, they overvalue the dollar and they invest in our markets aggressively and make it so that we can't manufacture things economically at scale. So it'd be kind of to try to right size that imbalance overall. But it'd be more about trying to maintain the strengths of what we have while kind of balancing things.
Okay. And one thing about the current system, so I make sure I'm understanding it correctly. You talk about, we're essentially giving foreigners the dollars to then buy an increasing share of our assets, right? Our stocks, our credit as well. Um, and that's great, probably for a long period of time, if you're an asset owner, right? So as you said earlier, that's kind of a tailwind to rising asset prices. So if I own asset prices, I mean, American owning asset prices, in the near term, I'm happy with that, right? The problem is you've got two potential expiration dates on that. One is which is where you've basically sold off an unreasonable amount of your domestic assets to foreigners, right? I don't know where that line is, right? But presumably you just keep increasing their share. At some point, they own everything, right? But along the way, I think probably before that, the domestic asset owners start benefiting so much more at the expense of everybody else. And this is the K-shaped economy, right? The top leg of the K is a lot, it's got a lot fewer people in it than the bottom leg of the K does. You add in the inflationary um, ramifications of all this. At some point, you probably, before the foreigners own everything, you get to a point where the bottom leg of the K just says, we got to do something totally different because this is just not working for us.
Yeah, I mean, it's kind of like there's multiple ways to affect a balance, an imbalance. There's kind of the messy way, or there's a strategic way. If
Hmm.
you act before there's a crisis, there's potential ways to kind of land the plane. It's like an emergency landing. Like you land, you survive. It's bumpy, it's rough, but you land. And the
Right.
other
The,
method is
the
kind of
plane
like
remains intact. Yeah.
yeah, and the other method is you kind of just keep ignoring the problem, and then you crash, and it's a it's not maybe not as bad as an actual plane crash, but it's a very messy, disorderly outcome. And so, for example, if you just ignore the problem entirely, and you just get rising kind of populism, you get rising, including the more extreme types, not the more rational types, and just kind of like more polarization, populism, um, just distractions, distrust in the system and therefore more extreme elements. Then you start going after the core reasons of the whole thing, which is like rule of law, faith in the kind of the soundness of the capital markets and stuff like
Yeah.
that. That's not something you want to give up. That's the bad reason to lose those things. Um, and so, and the other thing is that, or the more mild thing is you get into a phase. I think we're in that now. We start kind of picking and choosing winners, right? So you get kind of very top-down economic management, and there's calls to say, okay, we should stop big pools of capital from buying homes because they're driving up the cost of homes. But that's
Hmm.
I would say that's fixing the symptom more than the foundation, right? So the foundation is when you have kind of ever money that always gets weaker. There's all these entities that will then okay say, well, I'll borrow as much of that as I can and buy better assets with it. So I'm persistently shorting fiat currency and owning assets. And so that's the kind of the incentive mechanism there. Um, if money is abundant, people will short it and buy scarce things. Whereas if money is scarce, if you have sound money, there's less reason to do that. No one takes out a mortgage in gold because gold over a very long arc of time generally outperforms the average house. Maybe not the prime waterfront house, but most houses. But they take out mortgages in dollars, even if they don't need a mortgage. They could afford the house, but they're like, I'll finance it anyway, historically. Because why not short fiat currency for 30 years?
Exactly.
And so it's the more foundational things. And in this case, it's also when you're running a trade deficit, all this foreign capital needs to come in and buy stuff. The biggest one by far is the US stock market and bond market. They're the attractive markets. For Canada and Australia and a few others, it's more the real estate market. In the US, it's less so our real estate market, but it still is part of our real estate market.
It
Some
is.
some of these,
Yeah.
some of these big pools of capital are include foreign investing capital. Um, and so instead of kind of saying, okay, we want to place restrictions here and place restrictions here, it's better to have kind of a clean thing saying, okay, if foreign capital's coming in and buying these really big asset classes, there's kind of a tax on it per se. But then ideally, I mean, and the Trump administration ran on this. They even kind of floated, well, maybe we could replace income taxes with tariffs, for example. Of
Right.
course, in government, it never works like that. You get the tax and you don't get the replace thing, right? So
Hmm.
you have income taxes and tariffs. Thanks for playing. Um, whereas again, you can actually, if you do this cleanly, you could say, okay, well, here's this new kind of framework that's somewhat tax neutral, but then it chips away at the imbalance to say, okay, we're going to make it a little bit more costly to buy our attractive financial assets for foreign investors. And maybe even include some kind of like just blanket 10% tariff or something, not picking and choosing all the time, but saying, okay, this is just how, this is like a cost. But then
Hmm.
you pass that on to American individuals or businesses by saying, and here's a permanent reduction in your tax rate um, because we're getting revenue from this other source. And it goes after the imbalance to some degree. So, I mean, there are multiple tools, but this is somewhat hypothetical because a lot of these tools, other than tariffs, are not the ones being used.
Right. At least not being used now.
Yeah.
All right. I want to go back to Empress Lyn for a moment. And Lyn, we're going to enter into territory now from your book. You talked about how, a large part of the problem here is just we have this money that people know is going to lose value over time, right? And that provides what I would say in many cases a malincentive for players to do things that benefit them individually, but don't benefit society necessarily in the long run. So you're a fan of sound money. Um, if you were put in charge and everybody had to do what you say, what would you have the country return to? Or sorry, I shouldn't say return to. That's a leading question. What should the country turn to as a better alternative to the current fiat dollar?
It's a good question. I mean, in the long run, it ideally would be tied to a neutral reserve asset. So historically, that's gold, and gold's
Mhm.
still the only one big enough. Potentially in the future, something like Bitcoin, but it's currently nowhere near big enough. So the best you can do is accumulate some, should that ever become big enough to be something you could attach it to. I think, moreover, it would be about you could also put limits on the growth of the base money supply um, that are, depending on how soundly you do it, you could do it in law or you could literally do it in the Constitution if you want to go to the bedrock and say
Just
like,
saying that money supply is not allowed to increase by a certain percentage.
yeah,
Really?
yep, yeah, you could do that, and that's another way. You still have this kind of unbased ledger, but you have limits on it. Now, in practice, and here's another just painful part. I mean, part of the nothing stops us train thesis is we're already insolvent. We can't realistically um, get out of this without a default, which is to say there's a certain amount of base money, and then there's all these IOUs built on top of it, and those IOUs are multiple times the base money supply. And the problem is you can't go to hard money when you have that crazy IOU base money mismatch. Um, and if you default, the problem is that the whole system's circular. So someone's liability is someone else's asset. So for example, treasuries, I mean, they're over the long arc of time, they're functionally insolvent, but they are the bedrock asset for the Fed, the commercial banking system, many retirement in portfolios, insurance company
Yep.
portfolios. So all the things you think are like valuable that you own are tied to the not
Right.
treasuries not defaulting in mass.
You can't
Um,
write those off for default mess because everybody collapses.
yeah.
Yeah.
And the way that sovereigns usually default, quote unquote default, is they debase.
Yeah.
So they say, okay, everybody gets their units, but there's way more units now.
Yeah.
So,
You meet
but
it nominally, but you just kill the purchasing power of the currency.
yes. And then the question is, so do you let that kind of bleed out slowly? Or, I mean, the kind of the least messy way to do it is kind of what they did after World War II. I mean, during World War II, they printed all this money, but then they pivoted hard. They had more austerity afterwards. So there was a massive devaluation, but then they had built all these factories. They Money printing tried to go more toward the bottom and middle. So like
Mhm.
soldiers returning from war, it's like, okay, here's your mortgage support, and here, we're doing all this.
Here's the
Um,
GI Bill, all this stuff. Yeah.
exactly. And then outside of that, it's like pretty significant austerity. So you don't reduce the debt, but you stop adding to it, and you've already debased a lot of it, and then you kind of grow out of it. Now, of course, back then they had way better demographics and other factors, so it's much harder today. Um, but basically, it's okay. It's saying we're already insolvent. So do you want to just kind of like default in a disorderly way over the next 5, 10, 15, 20 years? Or do you want to make a couple clean, painful decisions? Rebalance Social Security, for example,
Hmm.
because I mean, that goes insolvent in the 2030s. Um, and also, I mean, want to fix the food system, right? And because the healthcare expenses are such a gigantic chunk of the budget. So you look at Japan, for example, they have much lower healthcare costs, even though they're on average 10 years older and they live longer, right? So we have a very specific problem here in the US with our healthcare
Hmm.
costs, and a big chunk of it is our food patterns. And so you have to actually fix the food system, which is it's so
Absolutely.
it's so
Our lifestyles are terrible on a relative basis, particularly to the Japanese.
yeah, they're terrible, but then there's also even government inputs that incentivize them to be terrible. Like we subsidize like the unhealthy foods. Um, and it's not an accident that when people go to Europe, they're like, "Oh, I feel so much better on this food," even though
Right.
it's in many cases similar food. So I would kind of do what they're like the new food pyramid, I think, for example, is great. But it goes deeper than that, which is okay, we want to fix food to some degree, at least stop incentivizing the bad foods, maybe replace those with incentive towards the good foods, but at least don't be incentivizing the bad things. Work your way up to get lower healthcare costs because you're reducing diabetes, metabolic syndrome, severe obesity, Alzheimer's, that kind of things that have more of that metabolic food connection than other things. Um, and so there's a handful of really big chunk things to fix, but the problem is it still does involve an inevitable currency devaluation because even clean sheet of paper doing things correctly starting like next year, it's already essentially um, insolvent. So there's going to be like a default, and that's going to be through debasement.
Okay. So you're sort of describing the emergency landing as there's a way to do this if you do it sort of slowly enough and gradually enough that you can get the plane to a better place. Still not
Right.
going to be great, but
But anyone who does it, that's the thing. They become kind of known as like the worst president of the era because like they'll be so unpopular, right? And
right.
maybe in the future people like will say that kind of worked, but then the problem is when you do it, you'll probably get riots, you'll probably get this,
Yeah.
and so no one. That's the thing. Like I literally wouldn't be able to fix it even if I was somehow in a position to.
So it can be frustrating being in our space, Lynn, to spend a lot of time thinking about this stuff and kind of having a sense for what you think should happen, but having a strong sense that it's not going to happen largely because of human nature, right? And I'm just curious. We could, I'm sure, spend a ton of time on this. I don't want to because I want to get to a few other topics. But does this make you more resigned to the fact that we're probably going to have some crisis at some point about this, and the reforms we need aren't going to materialize just until the pain of continuing the status quo starts to exceed the pain of the change?
I do, yeah, and I think I mean the way I generally describe it is I think we're gonna have a very long process of this. Basically, nothing stops this train, and it's punctuated by mini crises. Um, and so none of those are like the crises, the fabled, end of the system and then like the birth of the next system, but always like little
Mhm.
mini crises. And they will keep popping up and get put out, and another one will pop up and get put out and just delayed and pop up again and put out. Potentially some really big ones in the 2030s with like Social Security and things like that. Um, but yeah, I think I place a very low probability that we just do a handful of kind of key major painful reforms that kind of start rebalancing toward the right direction in a kind of clean, elegant way, rather than kind of a micromanaging, hodgepodge, chaotic way.
Yep.
Um, and instead, we just kind of keep layering stuff on. We do tariffs without taking away income taxes, or they say, okay, well, there's like you see in New York, they say, okay, well, housing is expensive. Let's do a bunch of policies that ironically probably make it more expensive, right? It's
Right.
like let's do things that make it disincentivize building new supply or ever wanting to be a landlord. Um, so I think we're going to try pretty much across the board, including both right and left at times, all the bad answers, sometimes nationally, sometimes regionally. And I think it's going to be a very slow bleed as everyone keeps blaming themselves and trying to figure out whose fault it is, and it's
Mhm.
it's a bunch of messy answers.
Okay. So Lynn, I mean, I've known you long enough that I'm pretty sure on most of these points you felt the same way 2, 3 years ago as you do now. Um, and then, of course, we've had AI rush onto the scene here. What what impact, if any, do you expect AI to have on the general trajectory here? Can it actually help us out a lot here? Does it just accelerate us to the next crisis? How are you looking at it? And I know you I mean you swim in very technical circles, so your opinion here I think is probably better than most of the people that I interview.
Well, so I'm on the board of a number of companies. I advise or I venture invest in a number of companies, and in basically all of them, AI is becoming increasingly important to be competitive. So they're all most of them are hiring less or re mildly reducing headcount sometimes. I mean, depends on how fast the other aspects of the business are growing. But it's like it is impacting hiring and overall efficiency because, I think over the multi-year time frame, a lot of white collar work, it's not that it gets displaced by AI per se, but that more of it shifts to overseeing and working with AI tools, including agents, AI agents. Kind of like how there's a big transition where almost all white collar work involved started to be using computers and just being very computer literate. And AI isn't magic. I mean, there's two things are true at the same time. One is that AI is incredibly impactful and a huge productivity boost. And yet, I was posting on social media today, and I'm not the first one to ask this question. If you ask a bunch of different chat tools, AI chat tools, I need to get my car washed. The car wash is 100 yards away. Should I drive or walk there? Um, a lot of AI tools would say, "Oh, you should walk there. It's short." It's like, well, the whole point is to get the car washed, right?
Right, right.
They fail the obvious context. And sometimes one tool will pass, and then the next day when you ask it again, it'll fail because it's not actually consciously thinking. It's doing this whole kind of, the whole
Mhm.
kind of probability next step in there
Sorry
method.
to interrupt. I read your tweet and I thought that was so interesting. Do you think that is just a function of AI that will continue, or is that just, the development, the growing pains with AI here, that in a year that problem will be gone?
I think that until they fundamentally do things differently, that problem will persist. Now you could
Okay.
shrink it over time. I mean, there's different ways to measure this. Like, so, for example, there's tests that show, like how many hours, like a task that takes how many hours could be done in a couple minutes with AI, and that has increased exponentially over time.
Mhm.
So, and like, like another way to put it is if you ask AI to write a short story about XYZ, it could do a half decent attempt at it. If you ask AI to write a 300-page book, it's gonna it's gonna be pretty bad because it
Mhm.
has trouble keeping in its like consistent characterization, consistent intricate plot over that long. And the same thing's true for coding projects. If you say, okay, make this little widget that does this, it can whip it up. But if you say, hey, I want this like complex architecture for this enterprise grade thing, and then I want it to have all these capabilities, that's where it fails. But that aspect is getting rapidly better over time. On the other hand, I mean, I've been involved in kind of testing out AI art generation for like 3 years now, and there was like a rapid improvement period, and then it kind of hit a wall and it like hasn't and the tools I use, a lot of them are kind of the more leading edge ones. They haven't really gotten much better. Now the new thing is like video, for example, but the videos aren't that great. But like there are things that are improving rapidly. There are other things that are kind of just running into natural ceilings that are really hard to overcome because the
Mhm.
model itself is just not thinking. But this goes back to my prior point, which is the tools aren't magic, but they are powerful. Kind of like
Mhm.
how a computer is not magic, it's powerful. But part of
Right.
getting the most out of a computer, and this was kind of the whole generational thing, like millennials versus silent generation or boomers. Obviously, people are all different though. Is growing up in an environment or if you didn't you take the time to rapidly learn to become just very comfortable with a computer because it takes skill to use a computer to solve problems correctly versus just doing it for you. And AI, even though it literally does a lot of things for you, there's still a lot of details around one, making sure that it's secure, right? So it doesn't just like go and actually you say to do something and it just deletes all your emails or deletes all
Right.
your files or something. So how do you manage giving it access to all your important stuff and not giving it kind of critical vulnerability access? Two, knowing how to ask the right questions or knowing how to seed an agent with the right documents or source material to do things properly. Three, to know its limitations enough to spot when it's messing up because it'll usually confidently do wrong things.
Right.
So you have to know enough to know when it's likely going to do something right, not doing something right. And this is built up through reps. It takes just using the tools. So one of the key just skills going forward in white collar work, especially, is someone who just naturally uses AI tools and is familiar with them and knows how to be a very productive employee at whatever they're doing because they are familiar with tools in a similar way that in the prior generation, familiarity with computers was a key thing. So that's a long-winded way of saying this is a massive productivity boon for white collar work. Um, we get a lot more abundance as a society. So kind of like how when tractors were invented and hydrocarbons and all the thousands of man hours that are in one barrel of oil,
Yeah.
one farmer can do the work of 10 or 20 farmers. And it frees up all those other farmers to do other things, and it makes food way cheaper for everyone else. This does that for white collar work, kind of like how automation did that for blue collar work in manufacturing. Um, and it's a disruptive thing. So in some ways it pulls things forward, but for the most part, it's a positive opportunity set. Um, as long as someone is taking the time to be familiar with the tools, seeing what AI is really good at, seeing what it's still bad at, making sure you're using the tools for your job, making sure that you're the field you work in is one of the more resistant ones to it, and not one of the ones that just goes away right, kind of early on. But overall, going back to my prior thing, when you have debasement and then you have productivity growth, the productivity growth disguises some of the debasement.
Right.
Um, and so on average, the more productivity growth you have, the more debasement they can get away with before it becomes like painful, right?
Yeah.
So
And that was sort of the nature of my question here. Do you see enough of a incremental productivity lift from AI for the next, however you want to say, 5 years, 10 years, 20 years, whatever, that they can just get away with a lot more debasement than they otherwise would have?
I think it's a factor, but I think it doesn't really change the fundamental nature of it because the rewards are going to be so lopsided that you still
Hmm.
have that polarization to contend with. I think the biggest factor overall, the single biggest factor is energy. So I think from a governance standpoint, the number one thing a developed country can do is don't get energy bottlenecks.
Hmm.
Which I think so far this administration is doing well. But in general across the board, make sure their oil flows, make sure the gas flows, try to be pro-nuclear, try to encourage new nuclear technologies that, don't take 15 years to or more to build a facility like small nuclear reactors, whatever the kind of the technological path is.
Hey, sorry
And
to interrupt, but how much of an electrical production deficit do you think the US faces right now? You've probably seen that same chart I have of comparing the US and Europe's electrical production to China. And China's, we're pretty much flat and they're almost vertical and they're already like 3 times as much as we.
yeah, that's a huge factor in why you can't just snap your fingers and teleport an industrial base.
Right.
And then the crazy thing that actually understates it because it's not just electricity generation. In China's case, it's also like when you look at steel manufacturing and other heavy industry, a lot of that is burning coal and then using that heat directly in the manufacturing process rather
Mm.
than transporting in energy first, I mean electricity first and then back into heat. So it's also direct heat generation capability. So it's electricity and heat. And you can't just snap your fingers and teleport all that. And one is it's expensive and time consuming to build. And then ironically, some of the electricity components we get from China to build out our grid better.
Right.
And then there's also NIMBYism to deal with.
Right.
That people say, okay, sure, AI data centers are fine, but I don't want them near me.
Right. And I
And
certainly
then,
don't want them making my electricity bill go up.
yeah, exactly. And so that's a big, complex regulatory and social political web to go through, which is also part of my reasoning for why I think this is actually going to be a long bleed. And I do think that that is a bottleneck on AI. And I point out before, the human brain runs on like 20 watts of power, like a
Yeah.
third of an old school incandescent light bulb.
Unbelievably efficient. Yeah.
Unbelievably efficient per calculation. Um, and so even though AI can, I mean, for a century we've had calculators that can do math better than us, right? But with much less processing power. Now we have AI. We've kind of gone up the full stack. It's still very costly per mental calculation or per
Mhm.
process. And that's a pretty fundamental constraint. Maybe give it another 20 years of Moore's law and other scaling methods to try to squeeze every efficiency we can get out of that, because that is a rapidly improving metric, but it takes time. Um, it's not just what can AI do, it's what can AI do cheaper than a human.
Mhm.
And I think that there's always a hardware side to this. So I do think that AI is a very powerful new white collar like productivity boost. I describe it as probably similar scale. We don't know for sure because this is a rapidly evolving field, but I would say it's close to the size of the manufacturing automation boom, throughout like the 80s and 90s, which was then also combined with the offshoring boom, right? So
Yep.
it's not an accident that offshoring happened when it did because we had better telecommunication technologies which allows a corporation to communicate with its employees all over the world in pretty high bandwidth ways. It's hard to run a foreign manufacturing site when you're doing it in Morse code, right?
Mhm.
But when you have internet and telephone and all this and file sharing and so forth, you can more readily run. Just your employees can be in multiple places, and you have efficient, cheap shipping. So that combination of industrial automation and kind of employee location flexibility, obviously all that was very bad for some and good for others because it lowered costs. I think that's roughly the scale we're talking about, but it's primarily services work.
Okay. So I want to ask you one last question on this. Sort of, we're talking about the light of AI, the potential good it can do. I want to talk about the dark just for a moment. But I'm just looking at the time. We're getting near the hour, so I want to make sure I get to ask you about markets too. But just real quick, in an unfairly short amount of time, um, you know, so it sounds like you're saying you think this is going to be a real boon for white collar work. And I'm curious if you think it's going to be a boon for white collar workers. We just had Microsoft's CEO of AI say that he thinks all white collar jobs are going to be gone in the next 12 to 18 months. It's kind of an attention grabbing headline, but obviously that's a lot of people's fear here. And a lot of the purpose of AI is to try to let one man do the work of many, just the way that steam engines did when they came on. Um, but when you map the increases in um, AI, artificial intelligence, and then you connect them with the physical world through robotics, and we seem to be on the cusp of an explosion of humanoid robots coming into the workforce. Is it going to come on the same, as quickly as Elon Musk is telling us? Who knows? But let's double his time frame, and so it's not next year, it's 3 years from now or 5 years from now or whatever. I have a hard time seeing the potential vast amount of jobs, both at the white collar level and at the services level, that could get displaced by all this combination of all this new technology. I have a hard time seeing the majority of that displaced labor finding something productive to do that's going to be paying them as much as what they're making now. Do you share that concern?
I do share that concern. There's a bunch of questions there. I mean, one, I don't think all white collar work will be displaced in 12 to 18 months, or anywhere close to that. But I do think that it, now is the time, if someone's a white collar worker, to be making sure that they understand AI tools and that they have time using them, because you're what you're potentially going to lose your job against is someone else who's doing the same job as you but uses AI tools and therefore has twice or three times the output that you
Right.
have for the same salary, um, or has your same output for half the salary. Um, now the other side of that though is that things that were once kind of expensive, so accounting service, if you pay someone to go over all your finances for you, that's a pretty expensive thing. Paying law work is pretty expensive.
Hmm.
And sometimes that's even used like asymmetrically. If someone's rich, they can go around suing people that are poor, knowing that those
Right.
people can't access they can't even try to defend themselves properly.
Yep,
Um,
absolutely.
and what one thing that AI does is it makes a lot of those things way cheaper. So even though some people have their incomes impacted, also the things they buy in many cases, in this case, the white collar services they buy will be cheaper. So the whole kind of industrial automation and offshoring wave, it literally caused the Rust Belt. I mean, it actually goes back to the whole dollar trade balance thing we talked about before. But in addition to all that technology, it caused the Rust Belt, but it also made electronics, plastic goods, textiles, and everything dramatically go down in cost,
Hmm.
both for people that don't work in those industries, so they get the best of both worlds, and for people that actually work in those industries. So it's like, okay, your income's disrupted, but also your expenses are assisted compared to the alternative. And I think it's kind of the same thing, which is, you know, design services, um, accounting services, law services, all editing services, translation services, all these services across the board do get way cheaper. And then even some physical things get cheaper because that company's back end is spending less on accounting and spending less on law and spending less
Hmm.
on things. So across the board, by reducing the friction, we make both physical and services on average cheaper, but then also impact many of our incomes in a way. And of course, the biggest problem here is it's not equal, right? So the main thing is that some people will be quicker to use those tools and be proficient and therefore stay competitive. Others won't. And then some work in places that are the income gets disrupted before their expenses do. Other ones work in a place where their expenses get cheaper before their income gets disrupted. And so there's no one answer to that question, but I would just remind people that there's both sides of that. and that they're
Yeah.
happening at the same time, but in a very bumpy way.
Yeah.
But it is a period of heightened turnover and churn.
Yeah. So I totally get that. And I agree with you. I think you know, educated, whether through schooling or self-work, go-getter is going to have a tremendous amount of opportunity ahead of them here coming in this period of transition. What I worry about is, which I'm sad to say, I think is probably the majority of people who just don't fit that mold for one shape or another. And up until now, okay, I'm not going to be the next Silicon Valley founder, right? But I can go get a dependable salary at job X. I'm concerned that there's the potential for so much shrinkage
Yeah.
of those jobs where at the margin, if a company is like, look, we get a new line of business we want to go into, I don't think it's going to be all that long before the default assumption is okay, well, I'm going to obviously start that with a technological agent, whether it's a software or robot or a combination of the two. And I'm only going to look at a human if I absolutely have to at the end of the day. And so the people who just sort of want the dependable 9 to 5, steady Eddie paycheck, honestly, I don't know what a lot of those folks are going to do because I just think a lot of those jobs are going to get AI or roboticized away. And the companies are going to have a mindset that's basically like, yeah, I don't ever want to hire a human unless you put a gun to my head.
So I agree with a couple caveats. One is, I mean, obviously the extreme cases like the Silicon Valley founder. The more middle case is, let's say you're a programmer or you do some sort of white collar work. Um, you want to have like eventually agents that are trained in the way you do things, combined maybe with how leading experts in this field do things, some sort of hybrid that
Hmm.
then can do work for you that you oversee, right?
Right.
So it's saying, and a lot of people still work for a company. Like I literally the startups that I am involved with, there are employees at those that are saying, okay, I used to do things like manually or I used to do things this, and here I have my agent doing it and I'm overseeing it, fixing all the errors that it makes because it doesn't know that you have to drive to a car wash if you want your your car
Right.
washed,
Yeah.
right? So that there's that middle ground of you're still doing the same output roughly what you were doing before, but you're using different tools to get there.
Right.
You're using AI to help you do it. Um, and then the blue collar side, skilled blue collar is I think one of the slower things to get disrupted because to your earlier question I didn't answer, I think robotics takes a lot longer because we just talked about how energy efficient the human brain is, right? The human body is also this mostly self-healing robot with a supercomputer that runs on 20 watts
Right.
um, and understands context for the most part. All that helps with edge cases. An HVAC expert drives to a house, gets there, the family dog runs out. They know it's not a threat. They know how to deal with it. They talk to the
Yeah.
the human. They explain the problem to the human. They get the human to agree to pay to fix. They climb up. They climb down. They do all this stuff. It's all the edge cases. I think skilled blue collar work has a pretty big buffer to it. Kind of like how automation really hurt the unskilled, like the lesser skilled blue collar, the more iterative blue collar
Right.
work. That's going to hit the white collar work. And then the problem is then a lot of white collar work tries to get into some sort of a little bit more physical work, a little bit more blue collar work, and they can drive down wages. But if someone's in a field that it takes like a lot of training, they have more of a buffer between their salary and this labor
Wave. Yeah.
shifting that's happening. So the rough thing is there's no easy way around it. This is a disruption. Obviously, it depends how quickly these tools get better. I do think, I mean, there are fundamental limitations to them despite being radically productive. Um, and depending on where someone is in that whole employee stack from Silicon Valley founder to the whole spectrum there, the main thing is to either have physical skills that are very hard to do using the fact that you have a 20-watt supercomputer and a self-healing robot body. That's one. Or
And
two,
where years of training is a good moat.
and where training is a good mode for user training. Or if you're in the white collar sphere, your training is that you're just fluid with using AI agents. And if you're an editor, you're the best editor in the world because one, you know how to edit, but then two, you know how to automate the parts that don't take skill,
Right.
right? So you maybe have an AI agent go through and clean all the obvious stuff that an intern can do, and then you use your human touch to, obviously do it properly. Make sure that the metaphorical, like, you're not walking to a car wash,
Right,
right?
right.
So you finding out ways to make it so that the parts that you're actually adding as a human are the really high impact, quality control, conscious thought stuff, and that all the low hanging fruit can just be made super cheap and quick, so that you're not being outcompeted by someone who is using those tools.
Yeah, and in many ways, you could almost say that like, this is going to enable experts to be able to spend a greater percentage of their time, maybe eventually all their time, you know, on the value creation that they get paid for, right?
Yes,
Where
that's
everything that's just busy work and gets in the way, I can offload that onto my agents, and I can just
yeah,
focus on the real value.
that's yeah.
Okay, thank you for doing this. That was very helpful. Hard shift here. So as you look out to the rest of 2026, it's a midterm election year. We entered it with valuations at remaining at pretty stretched extremes. The markets have been churning sideways now for a pretty good time here, and we've been seeing capital rotation, leaving or bleeding out of some of the sectors that have really driven the markets for the past bunch of years, and particularly I'm thinking of the hyperscalers and software, and moving into more sort of value plays and whatnot. So, with all that background and any other elements you think are important to note, like, what is your market outlook at this point in time? Is this a consolidation before we make a move higher? Are there structural parts of the market that you're concerned about? Is this maybe a topping pattern, because it hasn't gone anywhere in a bunch of months? What are you seeing?
So back in early November for my research service, I wrote about this CapEx spending by the hyperscalers.
Yep.
And was like, this actually is a material, this is massive shift. And so I became bearish on many of the hyperscalers. Um, and I have been in the camp that I do think we're undergoing a more of a value rotation. Now, it's not just value across the board. It's like value that's not value traps, right? So like actually kind of roll your sleeves up and try to figure out what is a future-proof company that's cheap, cash flow, positive, AI resilient, can use AI in its back end to cut costs, and is in a good position in that sense. Um, Emerging markets, while they had a good 2025, so maybe some of the easy money's out. I think that relative outperformance trend with some starts and stops has probably years ahead to it. Um, and so generally that more value or global focus, I think is good, because I think that the AI CapEx hyperscaler thing, I think is a persistent issue. The whole 2010s kind of booming market and early 2020s kind of during and right after COVID, that was a very kind of like asset light, CapEx light model where
Hmm.
all these mega caps, they had network effects, so they didn't have a ton of competition. Facebook didn't have a ton of competition with all its platforms, and Google didn't have a ton of competition, and Microsoft didn't have a lot of competition. And they had these kind of entrenched network effects. They made tons of profit, and then they just plowed that into buybacks. Um, and now they have to plow that all into capex, and there's there's not really network effects or as much economies of scale uh, for like AI providers or data centers. It's very easy to switch to another provider, which means that they have to constantly compete with each other way more
Right.
aggressively than they did before, which over the long run means the consumers and the business consumers win. So like the ones that are not those win, the ones that are buying the products, because they're basically
Right.
buying, like right now, I mean, AI companies are unprofitable. And so who's the winner there? Well, the ones using AI, because they're selling you
Right.
something that could cost them $30 a month and you pay $20 a month, and so forth. As long as that continues, the end users are the winners. As long as you are an end user and you're disrupting the people that are not using it or using it less or using it wrongly. Um, and I think that trend that continues for a while. So I do think that that there is a valuation right sizing happening. There were SaaS companies trading at 50 times earnings. And even if AI is overblown and those things don't go away tomorrow, like they're like lately they're being priced for,
Yeah.
if they just go down from 50 times earnings to 15 times earnings, and maybe it depends on the company, but sometimes some of them will get disrupted. Other ones, maybe their growth just slows a little bit because now a company can say, well, I could use your software or I could use AI to try to build it, but I won't do that if you make your price a little lower.
Right.
I mean, and you change your kind of model of pricing. Um, that some of them can still survive because they are doing a very valuable thing, but not at 50 times earnings. And so I think a lot of that is a valuation right sizing. My expectation is market keeps grinding for a while, um, and that you want to be in kind of on average cash flow producing things that are paying out dividends and still buying back their stock and are not as disrupted by AI or having to spend capex to be an AI leader.
Okay. That's super helpful. Thank you. And that all makes sense. Just curious, I'd like to get your quick reaction to something that Tavi Costa said when I interviewed him 2 weeks ago or so, where he looks at the massive amount of capex that the hyperscalers are spending. They're building real things in the physical world, right? That demand commodities to build these data centers and rebuild our grid and all that stuff. Um, so, as I'm sure know, he's a big commodities guy, and he's
Yeah.
been predicting that commodities were going to enter a new upcycle, which he believes is now underway. But he's looking at this capex spend as almost kind of like a value transfer from the hyperscalers to the commodity complex. So it's another reason why he's really big on the commodities and commodity producers. Do you see that somewhat similarly?
I do. I mean, that's why I've been long precious metals. I've been long kind of diversified commodity producers. I've been long energy producers or transporters,
Hmm.
or service companies that provide services and equipment to those types of
The
companies.
midstreams and stuff, yeah.
Yeah, and I think that generally continues. Now, obviously, energy's been pretty cheap. We've not really had any bottlenecks in terms of energy production lately, since kind of 2022 when the peak of that was happening. So that's overall a good thing. But yeah, I think it's not it's partially commodities, and it's also certain industrials. One of the trades that's run for a long time is and Warren Buffett was on top of this, which was buying they call them the Japanese trading companies, but they're not really trading companies. They're more like these like conglomerates that own anything like a company will own like a uranium deposit and a bunch of like convenience stores, right? It's like this crazy, but they own a lot of logistics infrastructure. So they're like industrials, commodity producers, and then sometimes also these kind of manufacturers or retail endpoints. Um, and they were trading like 6 years ago super cheap. Um, and they're these cash flow behemoths, and they've just tremendously outperformed. And I've been long that trade as well for many years, and that's just this quiet part of the market that many Americans have just not heard of. Um, and so it's not always just commodity producers. It's like this whole stack of kind of value stuff that makes just really valuable things and is profitable and was underowned and is now, doing great and getting some sort of valuation re-rating. So that includes what you mentioned, the whole section that Tavi mentioned. It can sometimes include owning the underlying commodities, or it can just mean owning value things that are not getting disrupted, and therefore, on a relative basis, they're outperforming the software stock that got cut in half,
Right.
just because it just kept chugging along and spitting out dividends and doing its thing.
Right. Okay. All right. Well, thanks so much. All right, Lynn, we're at the hour here, a little bit over, actually. Thank you so much. I just want to note, we'll talk about this in a second. We're actually going to have you back on Thoughtful Money in the not too distant future because you're going to be one of the featured speakers at the Thoughtful Money Spring Conference. Before we talk about that, though, the most important question for folks that just can't get enough Lyn Alden and can't wait for the conference and want to follow you in your work now, where should they go?
Lynalden.com. I have a free newsletter and also low-cost research service, so people can check it out.
All right. And Lynn, when I edit this, I'll put up the link on the screen there so folks know exactly where to go. Folks, the link will
Great.
be in the description below this video as well. Folks, please give Lynn a huge thanks for giving us so much of her time and her expertise. Please show that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would, in addition to signing up for Lyn's service, if you'd like to get some help from a professional financial advisor in perhaps, if you're thinking about taking some action on any of the macro things that Lyn and I talked about today, or whether some of the market outlook that Lyn has, if you don't have a good professional financial advisor advising you, Feel free to talk to one of the ones that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple of seconds to fill out. These consultations are totally free. There's no commitments involved. It's just a service they offer to be as helpful to as many people as possible. And lastly, and Lyn, I'll be quick here. As I said, Lyn's going to be a featured speaker at the upcoming Thoughtful Money Spring Conference. That's going to be on Saturday, March 21st. Don't worry if you can't watch live. Everybody who buys a ticket will be sent replay videos of the entire event, all the presentations, all the live Q&As within just a couple hours of the event's conclusion. It is a fantastic faculty, obviously, because Lyn is on it, but also, and Lyn, I'm going to do this from memory, but it's a pretty good lineup. It kicks off with Lacey Hunt. He will do his traditional keynote where he does a graduate level presentation on where he sees the economy going. He creates a lot of charts bespoke for this. We'll have first timers Ed Dowd, Michael Oliver, and Matt Taibbi, the journalist. We'll have Judy Shelton. She'll be interviewed by Danielle DiMartino Booth. We'll have Grant Williams. We'll have Stephanie Pomboy. We'll have Luke Groman, who you've mentioned several times already, Lyn, who actually just met in person for the first time last week, which was a lot of fun. But we'll have Luke and we'll have Brent Johnson. We'll have Michael Howell, the liquidity expert. We'll have Darius Dale. We'll have Rick Rule. We'll have Andy Scheckman. We'll have Melody Wright. There's probably one or two others that I'm not pulling up from my mind right now. But as you can see, Lyn, there's a pretty strong lineup. And again, Lyn Alden being the big heavy hitter there. So folks, if you haven't got your ticket yet, please encourage you to go to thoughtfulmoney.com/conference right now so you can buy your ticket at the early bird price discount. It's the lowest one we're offering. I want to make sure everybody gets that discount before it's gone by the end of the month. And if you are a premium subscriber to our Substack, check out your email. I've sent you a code you can use to get an additional $50 off of that low early bird price. Lyn, thanks so much again. Can't wait to see you in just a couple of weeks. I deliberately didn't ask you about digital assets because that's one of the things that we're going to be talking about for the conference. So folks, if you want to hear Lyn's thoughts about that, go buy your ticket now. Just giving you a chance here to speak to the audience of this video, Lyn. We've got definitely some professional investors here, but mostly it's regular people who are have worked hard to build wealth or working hard to do so, and they want to grow it prudently, but they don't want to become collateral damage to some of these maybe mini crises that you think we may be increasingly running into. What would kind of your parting bits of advice to them be?
One is the boring answer is diversification, but there's smarter ways to do diversification, which is not to own everything, but to say, okay, here's the major buckets. Here are the things I'm bullish or bearish on, so I lean into the bullish things. I've generally been using what I call a three-pillar portfolio. So one pillar is just profitable equities, pretty diverse, paying attention to general valuation trends and rapid disruption. Another one is cash equivalents for major sell-offs to have dry powder to rebalance.
Mhm.
And then the third one is hard assets. So that's sound monies as well as commodity producers and things like that. And that kind of mix protects you from a lot of different market conditions. When you have disinflation, the cash or the cash and bonds can hold up well. When you have inflation, it's usually the hard assets that are doing quite well. And when you have that kind of middle productivity growth, that's when the equities are doing quite well. And over the long term, that's kind of the more dominant side. And kind of thinking in those terms, I think is at least kind of the baseline starting point to do damage control and to see what the opportunities are.
All right, well, very well said. And obviously, if folks want to sort of see how you are positioning sort of tactically for any given market moment, if they follow your research, they're going to be able to kind of get closer to that pulse, correct?
Yes, yes.
All right, fantastic. All right, so again, if you're interested, folks, go click on the link in the description below for Lyn's service. Lyn, can't thank you enough. And again, look forward to seeing you in a couple of weeks at the conference.
Thank you. Looking forward to it.
All right, and everybody else, thanks so much for watching.
I think gold is going much, much higher.
Yep.
I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. I don't disagree with that. And as I just said, $35,000 per ounce, I mean, that's the highest numbers we have heard on gold today, right? That's my target. But what I'm saying is that does not
It is
rule out
not
a
a bubble.
40% decline into a deflationary bust where the Dixie can go to 122.
You can't expect rate cuts without some aggressive buying of the bond market. Who's going to rush in and buy all the US issued bonds in an aggressive way that it pushes prices up immensely, sufficiently for you to have that dip in rates that's going to lead to a 40% correction in gold?
The speaker, Henrik Seberg, along with Francis Hunt, projects gold soaring to around $35,000 by the early 2030s, calling it their long-term target, yet warns this doesn't rule out a sharp correction along the way. They caution that a deflationary bust, driven by a surging dollar index possibly reaching 122, could trigger as much as a 40% decline in gold before the next leg higher. With current rate cut expectations and without massive, aggressive bond buying to push yields lower, they question who will step in to absorb U.S. debt, suggesting that such market stress could create the conditions for gold's temporary collapse before its eventual climb to historic highs. Francis Hunt, the market sniper, in discussion with Henrik Seberg and Matthew Piepenburg, noted that while some foresee a 30 to 40% correction in gold during the next crisis, such a dip would be a buying opportunity. They argue a deep collapse is unlikely since today's rally is fueled by central banks like China and Russia, not just retail investors. Even a 15 to 20% drop would likely see these nations selling treasuries to buy more gold. Still, Henrik and Matthew caution that a strong dollar spike could trigger a meaningful pullback in a deflationary bust. Henrik Seberg, a macroeconomist, trader, and financial strategist, countered that forced selling could still drive gold lower, whether from hedge funds in trouble, leveraged retail traders, or even stressed sovereigns liquidating reserves. Matthew Piepenburg, macro strategist, author, and investor, highlights that in such moments, liquidity needs dominate, and because debt is denominated in dollars, gold often gets sold to raise cash quickly, just as in 2008. Yet unlike that crisis, today's backdrop is very different. Central banks, the BIS, and even discussions in the U.S. point to gold's growing role in the financial system, with BRICS nations using it for settlement in trade and oil deals. This stronger structural demand suggests that while short-term volatility and corrections may occur, the long-term trajectory for gold remains firmly upward. We're about to explore the video, but first, subscribe and hit the bell icon to stay up to date with our latest uploads. Your feedback in the comments is always appreciated.
What Henrik is saying is valid. For me, again, I'm still agnostic because I started buying gold 20 years ago. If we have a 40, 30% dip in the next market crisis, I'm relatively using that as a buying opportunity. But smugly,
But hold on, you have the notion that we'd have a 40% drop in gold. What do you think?
I don't think we will. I don't think we will. But we have to. We have to. What's that?
What is China? The gold is running not because of you and I. It's running because of central bankers.
That's my view too, Francis. I agree.
If the treasury market is doing and the dollar is doing what Henrik is saying, and you're having a 40% drop in gold, if you even just get to a 20% or a 15%, what do you think China and Russia are doing with any dollars or treasuries they hold? That's amazing. Thank you for the liquidity. Have it all back. These guys, China is a patience trader. They are not a trader. They're a patience investor. They sleep on the riverbank and wait for the dead bodies of their enemies to come by. That's
why I think it's ultimately
that will absolutely unload everything into wherever the sudden liquidity is coming from. So how do you get a 40% collapse with all the major central banks, probably including Switzerland, which is supposed to be a friend, but was also been accumulating gold? Every major central bank, which is the key move the needle gold buyer, on a 40% drop. So we're at 3,300. You're talking 1,700, 1,800. Great. They're going to load up and they're going to get rid of all those treasuries. They'll be doing it long before you get that 40%. And I
don't think it tops yet. I think it has a little more a higher move than before we top, but I think the top is in around 3,700 or something like that. And then I think you're going to see with the Dixie spiking up like that, you're going to see a very large decline. And again, into a deflationary bust like what we could see here, everything is overvalued. We agree on that. Everything is overvalued.
Who's selling the gold and who's buying the treasuries?
But it's not.
It will be about trader.
because you'll also have a situation potentially where there will be, you had a situation also where gold actually dropped because there was at least the rumors said there was a hedge fund, in problems, and they had to go sell gold, and you saw a large decline in that gold. I can't remember when it was. It was not so long ago. So things can happen. If the floor opens up and a lot of people are starting to lose their money on their crazy crypto investments or whatever it's going to be, or their hedged long
that's retail.
Leveraged.
That's not central.
No. But
this is good. This is
exactly.
good. This is good because it's important to have a disagreement on the DXY. We agree on gold.
What we're actually saying is crypto kiddies that are losing money on crypto, who happen to be big gold holders, are now going to be selling their gold, and they're going to crash the gold market in an environment where the central bankers are
state. It can also be sovereign nations that can be in problem. Can get in problem if you start to see that they're the yield levels are spiking off.
But Henrik, are you saying that in this event where the Dixie spikes in this short-term window of shit happens, excuse my French, is that going to be driven more by a need to sell gold for liquidity, or driven more by a need to buy U.S. Treasuries as U.S. dollars for safety in that moment?
I don't think there's either or. I think there'll be a plethora of things. I think it'll be driven by the need for liquidity, and the only real liquidity is where the debt is denominated in, and that'll be denominated in dollars. You can't pay off your debt with gold. You need to sell gold, and the thing with gold is that it's fantastic to give you liquidity when you need it, and that's what it's there for. So you'll probably see that the sell-off will be something
what happened in 2008. I'm just trying to find.
Arguably, is the 35% decline
unlike
you had
2008. I'm just trying to. I'm not saying this isn't a foolish argument.
No, that's fine. We just
unlike
discussing.
2008 though. Today in 2025, the mood, the need, and the status of gold, not just in the headlines, but literally at the BIS, literally at the Fed, even all this nonsense and discussion about gold-backed U.S. dollar again, and not to mention revaluation, not even going down those rabbit holes. What we're seeing with the use of BRICS gold as a trade settlement for net settling, what we're seeing in the oil trade, what we're seeing with the stacking of physical gold in the East, don't you think the environment from the BIS to the Shanghai Exchange to the SPYMEX in St. Petersburg is so different now than in 08?
Henrik suggests gold isn't in a bubble, but simply preserving value as fiat currencies weaken. Its rise may reflect a fiat bear market rather than overvaluation. Silver, platinum, and miners lag behind. Some argue gold has front-run inflation fears and could pull back if the dollar spikes, like in 2008. Others note it hasn't reached inflation-adjusted 1980 highs, and with record global debt, gold's long-term fundamentals remain strong. The broader view is that gold has solid fundamentals, unlike Bitcoin, which some describe as a bubble driven by speculation. Gold is backed by decades of central bank demand and its historic role as real money. Analysts like Francis, Matthew, and Henrik collectively highlight patterns where gold has outperformed stocks after major crises, comparing today's setup to 1929, 1971, and 2000. While a deflationary bust could temporarily make the dollar everything, forcing some gold liquidation to cover debts, the longer-term trend still points to dramatic gains. With projections as high as $35,000 by the early 2030s, gold's role as a hedge against excessive debt and fiat debasement seems more relevant than ever. Now let's get back to the interview.
What if gold is not in a bubble at all? What if gold is simply doing what gold does best, and the only thing that's in a bubble is the U.S. dollar or the yuan or the yen?
Somebody should have told platinum, silver, and GDX.
I think the GDX, I think platinum, platinum's other conversation. I think silver always is the little speedboat that can, once gold hits a bull market, but gold isn't in a bull market yet. That's why silver hasn't taken off.
But I think silver actually looks even worse than that. And we also know that normally when we have a real gold bull market, we'll see silver follow. Silver is not at all-time highs yet, and there's nobody who can tell me technically that this looks strong for silver.
Early stage.
No. This is actually late stage. This is late stage if you look technically. You have that the silver is making lower highs on a weekly basis when it moves higher. That tells us that you're moving into a level where it's probably, and I'm saying it's around 41, 40 something, 42 maybe.
Yeah, but that's
where
a
you're going to see
point.
a decline.
I also see silver being rejected in the 40s before running 50.
But this is actually a very big rejection. And it just doesn't make sense. It doesn't make sense. It doesn't make sense that but gold should just keep moving higher. And silver, by the way, gets rejected at levels which are far lower than the all-time highs. And by the way, miners does the same, and so does platinum. So what if The most rational explanation is actually that gold has been front-running things a little here because everybody's been talking about inflation and how debt is a problem, and that debt is a problem.
Devalued. It's artificially devalued.
And that is why it's going to have a relative larger pullback when the Dixie is going to, when we go through this whole shit.
There's an industrial component to silver, number one. And
that's my perspective.
I get your perspective, Henrik.
That's my perspective.
And hyper-stagflation, there's an industrial component.
We're not stagflation now. We 2.7%, there's no stagflation.
We are absolutely not getting consumer buying. So there's not the same.
But we have 2.7% inflation. We have 2.7% inflation. That is low historically.
You've been
very, very low.
A number of 2%.
But you don't actually believe that's the real inflation number. And silver priced in gold terms is still very cheap, as is platinum. And technicals, you guys are far better than me, but we're at a 45-year cup and handle for silver. I think silver's just waiting for gold to actually have a bull market. I don't think it's a bull market. Gold is kind of itself in a bull market, maybe a little bit inflated, hype, front running, and that the real, and I'm simplifying that, when there's a real moment, that there'll be an 08-like sell-off, because 2025 is very similar to 08. I would argue it's different. But if you were to change your thesis, it's a little bit, if you could think of, and maybe you don't, that it's not that gold is in any kind of a bull market. If anything, gold is doing what it always does, which is nothing. It just sits there. Well, fiat money is very busy, and sovereign debt is very busy debasing fiat money. And what we have is a major, I think, fiat bear market, and a bull market for gold is simply waiting for the fiat to die.
That we agree on.
But you don't think there's a difference in degree? That you still think the gold is overvalued given the level of U.S. or global debt? You still think it's overvalued?
No. I think, as I said also, I think gold is going much, much higher. Yep. I have a target of $35,000 or something like that going into early 2030s. And I think we're going to go there. I just want to say, like when I'm talking to Bitcoin guys also, I'm saying, you know, guys, I know the saying of the institutional adaptation and all these things, you know, but by the end of the day, I think it's a bubble. Okay. And I think that's the way it is. What I see with gold is that I think gold has a fundamental and it's going to also, if I look at Bitcoin gold actually ratio, you can also see that there is something to that. Bitcoin was outperforming a little more, and then you're going to see gold actually taking over again. If you look to the SPX versus gold, you can also see that we have a similar situation like what we had in 1929, in 2000, and in 2000 actually, and also 1971. Sorry, also with Nixon. So we have a unique situation here where yes, gold is going to outperform in the longer time frame. That is if you take the dollar out of the equation. But that's not what you can do in a deflationary bust, because that is when the dollar is everything. The dollar is everything, because you need to pay your debt. So if I get it right,
when you say the dollar is everything, you're saying the debt instrument is everything too. You've got to talk about both. Who's buying the debt?
Yeah,
but this is a gold bubble, apparently, according to you, at the moment. How can you? I don't see how technically you can say that. We haven't even reached 2000. The 1980s
no, I'm not.
high.
I'm not.
This
first
is
of all, I'm not.
Adjusted for the fake statistics that you like. The BLS, these are their stats, dividing by the CPI. And that's where you are. You haven't even met the CPI adjusted high of 1980. And we are in 130% of debt in the United States, 39 trillion, where we were compared to in 1980.
While short-term volatility and even sharp corrections in gold remain possible during a deflationary bust, the long-term outlook remains overwhelmingly bullish. Central bank accumulation, rising debt burdens, and fiat currency weakness all reinforce gold's role as a core store of value. Whether or not interim sell-offs occur, the trajectory toward dramatically higher levels, potentially $35,000 by the early 2030s, reflects gold's enduring importance in an increasingly unstable financial system. If central banks continue to buy aggressively, could they prevent any major gold correction despite a dollar spike? How might silver and other precious metals respond once gold officially enters its next major bull phase? We welcome your insights in the comments section below. If you found this content valuable, don't hesitate to give it a thumbs up, and don't forget to subscribe to stay informed. Thank you for joining us on this journey.
China is buying gold like crazy. The people in China are buying gold. They love gold. And the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system. And they plan to build gold vaults in many other countries. Gold is clearly in a secular bull market. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1-2 years, doubling in price immediately and running to maybe 8,000-9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable.
China is both the largest gold producer and a heavy buyer, with its people and central bank consistently accumulating gold as a hedge against the US dollar. China is building vaults abroad to back trade in yuan with gold, challenging the dollar system. China's central bank has increased its holdings of gold for 10 months in a row, ending in August 2025. Their gold reserves rose to about 74.02 million fine troy ounces. Gold is in a long-term bull market, and while a sudden surge to $8,000 to $9,000 within a year or two could signal a bubble, the current steady rise looks healthy and sustainable, pointing to much higher prices ahead. Florian Grimmies, a precious metals and cryptocurrency analyst and investor, highlights that central banks in China, Russia, and India are buying gold instead of Bitcoin, while the US is pushing into digital assets to maintain dominance, raising concerns about surveillance and sustainability. A World Gold Council survey shows 76% of central banks expect to raise gold reserves in the next 5 years. China has boosted its gold reserves for 10 straight months, joining Russia and India in favoring gold over Bitcoin, which remains too volatile and unrecognized as a reserve asset. Rising stagflation risks, low growth plus high inflation, are driving demand for hedges like gold and real estate. Analysts warn that while gold's inflation-adjusted price is at record highs, steady demand could lift it toward $3,700 to $4,000 per ounce by 2026. Tracking wealth in gold or Bitcoin, rather than just dollars, shows how purchasing power continues to decline. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
The Chinese, the Russian, and the Indian central bank are buying gold and not Bitcoin. The Americans desperately need something new to continue basically running their hegemony, and apparently they decided it's going to be the digital asset space. It makes sense to a certain level. At the same time, a digital dollar as a stable coin is just really much better. No, it's not. I mean, I'm very much worried about the whole surveillance kind of thing. I'm not sure if Trump himself really understands the whole thing. I think he has a lot of advisors who are telling him what to do and what to say, but if he really understood it, I don't know. It probably is the last chance that America can do, because they are not having enough gold.
You know, it's interesting. I read recently that Trump's assets, his corporate and family assets, have shifted from real estate predominantly to now crypto and Bitcoin predominantly.
Of course, no, it's amazing. I mean, who would have thought that, right? A year ago. To a certain extent, I would say yes. I mean, I think, first of all, the Trump family just wants to make as much money as possible.
Okay.
So that's, I think, the major intent here. And I think it's very questionable what's going on here. Very questionable. But at the same time, of course, I mean, the administration before was also extremely questionable because they were completely against it.
Yes.
Didn't allow any invention here and progress. So I at least that's what I appreciate now with Trump. But I think it's a turbo casino capitalism kind of style here. And Trump makes sure that his family makes a fortune here. And anything else, I don't know. Is it really better? I mean, yes, they create more demand for US treasuries if people buy more Tether, and then this is getting converted into the crypto market. Yeah, okay, but is this really sustainable? I don't know. I mean, the whole thing is more and more questionable in my opinion. Yeah, exactly. That's what's going on. On the one hand, massive expansion of the money supply, and not only in America, all over the world. If you look at these numbers for the European Union, if you look on Japan, on China, Everyone is basically printing money. And on the other hand, the consumers are losing the confidence in these currencies, in these fiat currencies, because they see that they have less and less purchasing power. And so people are trying to escape into hard assets. And that's why, at the end of the day, real estate is still holding up rather well. Okay, there is regional differences, but overall it's holding up well. And in many areas, actually, real estate is still getting more expensive. Your stock market overall, even though there's lots of questionable things happening in the economy, and you see that basically a stagflationary kind of scenario, the stock market is higher because people buy these stocks as a hard asset, so to speak, moving their money out of the fiat world. And gold, precious metals, mining stocks are moving higher, and crypto as well. And even your rare stamps and your old timers are getting more expensive because the fiat money is losing purchasing power and people losing confidence. I mean, you can see it in many countries, the society is becoming rather unstable. Some of them are actually close to a civil war. These are all the consequences out of it, and this is just continuing. I don't see a turnaround. It basically says that on the one hand, central banks, politicians, increasing the fiat money supply, basically printing money out of thin air, and on the other hand, consumers and participants in these financial systems are losing the confidence because they can see that the purchasing power of their fiat currencies is diminishing by the day in the end of the day. And that's basically happening at the same time. And what it means is your assets or your investments can go up on a nominal basis, while in real terms, they haven't moved at all. But people only look at the value of their assets in nominal terms, meaning in dollar. I mean, how many people are actually looking or calculating their net worth in Bitcoin and in gold ounces? It gives you a totally different picture over a 5 or 10 year time frame than just looking at it in terms of how many US dollars am I in total, or how many euros or Canadian dollars, right? So I'm doing this as a little homework every 4 months, updating a little Excel sheet, tracking my net worth, and you can see how challenging it can be actually to keep up in terms of Bitcoin and gold with your total net worth. You know, you might have more euros or dollars, but not more Bitcoin and gold.
Florian recalls, in 2022, when the Fed hiked rates, Bitcoin crashed, and gold dipped but held much stronger as a safe haven anchor. Since its triple low 3 years ago, gold has risen over 130%, supported by 4 key drivers: expanding global money supply, the bond bear market pushing institutions toward gold, massive central bank buying since sanctions on Russia, and China's relentless gold accumulation for both citizens and reserves. China, already the largest producer, is building vaults abroad to back trade in yuan with gold, challenging the dollar system. This shift is unwinding decades of paper gold price manipulation, as physical demand now drives the market. Beijing is also making gold imports/exports easier. It's seeking feedback on streamlining licensing processes, longer valid licenses, more customs offices authorized, to smooth gold trade. China's consistent accumulation supports the idea that demand from major sovereigns is backing gold's secular bull market. The fact that China is pushing through regulatory/reform steps for gold import licensing underscores a long-term strategy rather than a short-term bet. Central banks globally continue with strong, steady gold purchases in the face of geopolitical risk, inflation, and concerns about US dollar reserve dependency.
First of all, in that 2022, when the Fed started hiking interest rates and everything came under pressure, Bitcoin went down to $15,800 from $69,000, and gold came down to $16,15 from 2070-ish. And had a triple low, more or less 3 years ago. But gold held up much better during that time than everything else. So I remember being very happy having a large chunk of my portfolio in physical gold, because it basically stabilized and was rather in a safe haven anchor in that time when everything else was plummeting. So since then, yeah, gold is up 130% since that triple low 3 years ago. And you asked for the driver. So in my presentation yesterday in the morning here at the conference, I presented my take on it. I think there's 4 big, very important macro drivers for gold. The first one, I mentioned it before already, M2, money supply, the liquidity basically in the system, constantly being expanded over the last few years, and especially now again in the last few months. And not only in America, but also in the Eurozone, in Japan, in China, wherever you go, basically. If you would look at South Africa or Brazil, you would basically see similar numbers. So liquidity expansion. Second big driver is the bear market in bonds, especially in the long-term bonds. So the long end of the bond market, I think the Fed has lost control over it already. We have still a rather persistent inflation. And if you're an institutional investor and you have to seek safe, conservative, long-term bonds, and now you're in a bear market in bonds, it's very challenging. So I assume more and more institutional money will go into gold because it's the only other asset that they can buy. So that's the second driver. The third driver is central bank buying. We haven't seen that in like decades, that strong demand from central banks. Of course, it increased dramatically since Russia invaded Ukraine, when the whole world realized, like, whoa, the Americans, NATO, the Europeans just can confiscate our assets whenever, however they want. So now lots of emerging market central banks and nations are trying to diversify themselves out of the dollar, out of the euro, de-dollarization. Central banks are buying gold. They don't chase gold, but they also don't really care about $100, $200. So that's exactly what we've seen over the last 14 months. Whenever there was a consolidation in gold, you didn't really have a big pullback because very quickly physical demand showed up in the market again. And the last one, which is also very important, probably the most important besides the central banks, is China. China is buying gold like crazy. The people in China are buying gold. They love gold. And the central bank is also buying gold on a consistent monthly basis, basically. China is the largest gold producer already, and they consistently buy more gold. They use this, of course, as a way also to attack America, because gold is the antidote to the American fiat dollar money system. And they plan to build gold vaults in many other countries. Yeah. So if they do their trade business with Saudi Arabia and they buy the oil from the Saudis, they will give them the renminbi, and the Saudis can take these renminbis, go in their own country, go to the vault, here's the paper renminbi, show me the gold. I mean, this is what the Chinese are working on, to inject confidence into their yuan kind of system, building an alternative system to the US dollar system. And that's not going away. Those four drivers that I just mentioned, I mean, they're going to be around for the next 1, 2, 3 years at least. It could maybe take a decade or even longer until this fully plays out. And I think during that time, gold will be strongly supported. There will be strong physical demand. And out of the consequences also out of those four drivers is that you are seeing now the unwinding of that 50-plus decade Anglo-Saxon paper gold Ponzi scheme kind of system, right? Yeah. So we know that in the past five decades, the price making or the price finding for gold has been dominated by trading 200 paper ounces of gold for 1 real ounce of gold. That's how mainly the price finding has basically happened. And this is being unwinded now. And this can take a long time. And again, I just mentioned it before, gold is super strong, no real pullbacks here, no dips. People chasing, running behind the train. It just pushes higher, and whenever there is a dip, immediately big hands showing up with physical demand. And I think it's super bullish. Gold is clearly in a secular bull market. I think the price targets that you and I were talking about 5 years, at around $9,000, if you remember. Yeah. I think that's still the case. We probably have to revise them, and it's probably gonna go even higher. The only caveat would be if we see gold now really accelerating dramatically over the next few months and maybe 1, 2 years, doubling in price immediately and running to maybe 8,000, 9,000 in the next 1 or 2 years, then it would probably have the characteristics of more of a bubble, and we would have to be careful. But if it's just pushing higher like it's been doing now the last 14 months, I think it's very healthy, it's very sustainable, and we're going to see much higher prices. And this can last for at least a few more years, at least.
Could China's gold-backed trade strategy accelerate the decline of dollar dominance in global finance? How might central bank gold buying continue to influence prices compared to private or retail demand? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, thank you for being with us, and wait for the next updates.
Now we're just starting another leg, which I think will be at least symmetrical to the prior leg. So we had the move from under 300 to 1900 consolidation. That was a six-fold increase. If you assume we go up six-fold from 2000, that's $12,000 gold. So I kind of, at a minimum, I think that that's where we're headed. But if we end up having a dollar crisis and a U.S. sovereign debt crisis, we can go a lot higher than that. There's a good chance that that's going to happen. You asked me what's driving this. It is the monetary and fiscal policy of the United States, which are disasters. Once silver is above 50, once we're at 51, 52, and 50 becomes the support, I think it's not going to take long for silver to double to 100. I think that move will happen quickly. It may happen in a matter of months.
Gold can rise dramatically, potentially reaching $12,000 if the next leg matches past gains, with even higher levels possible in the event of a U.S. dollar or debt crisis. They attribute the rally to America's poor fiscal and monetary policies. For silver, once it breaks above $50 and holds that as support, they expect a rapid surge toward $100. Peter Schiff, the speaker, is a prominent financial analyst, economist, and CEO of Euro-Pacific Capital. He contends that the Fed's rate cuts in the face of growing inflation are contributing to the increase in gold prices. Mining stocks rose 30 to 40%, indicating that investors are now embracing gold's power. In an effort to lessen their dependency on the US dollar, which would make it more difficult for the US to pay for imports and debt, central banks are purchasing gold. Gold is a useful substitute for fiat money since it can be easily utilized for payments through tokenization or digital systems, thanks to modern technology. Gold is the real money of the free market since it maintains and even increases worth over time, unlike currencies, which depreciate. As we present clips from the video, please like this video, subscribe to our channel, and turn on the notification bell to stay instantly notified every time we upload a new video. Thanks for the support, and enjoy the video.
And I think that's really what's helping to drive the move in gold now and down in the dollar is the Fed is about to start cutting rates into rising inflation. And it's hard to imagine when they've done that before because inflation is above their target and rising, and they're going to cut into that. So it's the opposite of what they should be doing. Even though the economy is weak, inflation is strong. And that should be the primary mandate, is to get inflation back down. But they're going to abdicate that role because of the political pressure to try to artificially stimulate the economy, the housing market. So gold is going to take off from here. We basically just left the launch pad, and we got a long way to go. But the whole time that gold was going sideways for 3 or 4 months, gold stocks were quietly going up. Gold stocks went up 30, 40% while the price of gold traded sideways. And that's something we haven't seen during the entirety of the bull market because the investors in mining stocks have never believed the rally. They've been skeptical the entire time. They're finally starting to accept the fact that gold's not going to crash. But these gold stocks are not priced for current gold prices, let alone the future gold prices, but at least they're pricing out a crash now. People accept, okay, gold's going to be around this level, so we got to bid up these stocks because they're still really cheap, even though they're up better than 90% on the year. And gold mining stocks are the #1 performing sector in the market this year, and they're hardly ever discussed. No one talks about them. Well, I think that is going to happen. I think it's pretty clear. If you look at the main buyers of gold the past couple of years, it's been foreign central banks. Why are they doing that? I think they're preparing to replace their dollars with gold. I think gold is going to become the primary reserve asset for central banks. And that's going to be a game changer for the United States because the world is not going to need our dollars anymore. Well, if they don't need our dollars, then how are we going to buy all the stuff that we need because we don't produce it? And how are we going to finance our debt? Because we've been relying on foreigners to finance that debt because they have the savings that we lack. So it's a big problem for the U.S. But I think from a monetary perspective, you're going to see, I think, people utilizing gold using the technology that exists today, whether it's on-chain with, tokenized versions of gold, or whether it's just through proprietary closed systems where, the custodian has the gold and just uses technology to allocate ownership digitally so that people can transact business, receive and make payments, send money and receive money using gold, right? Just like using PayPal or Venmo or any other, Zelle or any of these things, you can just use gold. You don't have to transfer your gold. If I wanted to buy something from you and you wanted me to pay you, a gram of gold for it, right? Whatever that is, 30, 40 bucks, whatever, right? I don't have to send you a little bit of gold in an envelope and mail it to you. If the gold is held in a custodian and I have it tokenized in my wallet, I can just email or text you the gram. And now the ownership of the gold goes from me to you. So now you own the gold, not me anymore. You've got it. It's in a vault. Now, if you want the gold, you can have them ship it to you. But why do that? Just hold on to the ownership receipt, because now if you want to buy something, you can pay with gold, because the guy that wants to sell you that, he wants gold too. Why would people prefer gold to dollars? Because gold holds its value. Why would I want dollars when I can have gold? It's like, why use the post office when I can send something by FedEx, right? The free market has provided me with a better alternative than the government, right? Why do people use Uber and Lyft? Because taxis are too expensive. Why are taxis expensive? Because the government provides the licenses and regulates them, and so they're expensive. The free market alternative is, well, I'll just call an Uber, right? So the equivalent of an Uber in the monetary system is gold, right? Gold is the free market's money. Fiat is government money, and it's lousy because it loses its value. The longer you hold it, the less it's worth. The opposite is true of gold. The longer you hold your gold, the more it's worth. So given a choice, which would you hold?
According to Peter Schiff, the $50 mark, which was last attained in 1980 and 2011, is a significant barrier for silver. He anticipates a sharp increase to $100 once it breaks above, because shorts will have to cover. This was largely driven by global industrial demand, which, according to the Silver Institute and Metals Focus data, rose by 4% to another record of 680.5 million ounces in 2024. For the time being, he would rather Wall Street remain closed so that his clients can purchase gold and silver equities at a discount. Despite extensive marketing, Bitcoin has underperformed gold for years. He suggests purchasing gold mining equities in addition to actual silver, since he believes they are still cheap. He prioritizes selling gold at modest markups over expensive items at his business, Shift Gold. He cautions that it is dangerous to wait for dips because prices are rising and a reversal will probably occur from much higher levels by then. Let's get deep into the interview.
Very realistic. I mean, especially if you have $10,000 gold, $200 silver, what is that, 50 to 1? I mean, so that's very realistic. And I think potentially silver could go higher than that. But right now it's above 41. It does have this psychological, and not just psychological, real resistance at 50, because we have a double top there that goes back to 1980. And then again, we hit it in 2011. So silver has not broken out yet. While gold has, silver is still in this range. So I do expect that it will, there'll be some overhead resistance. But I think once silver is above 50, once we're at 51, 52, and 50 becomes the support, I think it's not going to take long for silver to double to 100. I think that move will happen quickly. It may happen in a matter of months, right? Because once we take out that resistance, there's nothing there. And I think there's also a lot of shorts out there in silver that, are going to be in a lot of trouble trying to cover those shorts and buy silver that really doesn't exist. I actually like the fact that this bull market isn't on anybody's radar, because I just assume Wall Street buy into the market later at much higher prices. They don't need to get in now. I want my clients to get in now. And the less competition, the better. I just want to get as much, gold mining stocks and silver mining stocks as I can. And the last thing I want is, Merrill Lynch and Goldman Sachs telling all their clients to buy, right? Because that's going to make it more expensive for my clients. So the longer they ignore this bull market, the better, as far as I'm concerned. Like, I'm in no hurry. I waited plenty of time for this, and I'm in no hurry to speed it up right now. But I do look at that as a positive sign that nobody's invested. The public, has no idea. You have one group of people that are still fixated on Bitcoin, and they're buying Bitcoin instead of gold. Although Bukele, I just read that he just put $50 million into gold. So maybe he's figuring out that Bitcoin is the wrong way to go. But, it's interesting that Bitcoin is barely up today, and Bitcoin is more than 15% below its peak priced in gold from 2021. So 4 years, Bitcoin's been losing value relative to gold, despite all the marketing hype surrounding Bitcoin, all the ETFs that were established, the NFTs, the Super Bowl ads, the celebrity endorsements, Donald Trump and the Strategic Bitcoin Reserve and the Bitcoin Czar and making Bitcoin the capital of the world, right? All that pump, and they can't even get Bitcoin to go up. So what does that tell you? But what is going up is the one thing that's not getting any hype, and that's gold. And now silver, going up as well, but not into record territory. So these gold stocks, I think, are still extremely cheap. They could double again from here, and I don't think they'd be expensive, especially considering that if the gold stocks double from here, gold's going to be a lot higher. So it's like they still wouldn't have caught up to where they should be. So we got a long way to go in the mining stocks. In fact, in April of this year, I kind of aggravated some of the guys at Shift Gold because I put out this report that said the best way to buy gold, and it was to buy the gold mining stocks. And I was telling my clients for the first time not to buy gold. And gold was around 3,200, 3,300. And I said, look, I'm a gold bull. I love gold, but these gold stocks are so cheap that it doesn't make any sense to buy gold above ground. Just buy it while it's still in the ground because it's so cheap. And while gold went sideways for all those months, the gold stocks were soaring. And they're not as cheap as they were, obviously, but they're still very cheap. And I still think people should be buying gold stocks and gold now, and physical silver and these silver miner stocks. So, Shift Gold is my gold company. What you want to don't do, there's so many, unfortunately, shysters in the gold industry. And they rip off their customers by pushing them into these numismatics or collectible coins, fake numismatics, proof sets, odd weighted, coins you've never heard of. And they do that because the markups are 30, 40, 50% or more. And so you need the price of gold to go up 50% just to break even. So why buy gold at 3,600 if, you need 5,000 just to get out even? So at Shift Gold, we're marking up gold like 1%. So if you bought gold yesterday, you can sell it back today and make a profit, right? So you don't want to get ripped off. So going to Shift Gold, you're going to get the best prices. You're going to get just bullion. We're not going to try to push you into something that makes us money. We're going to sell you what you need to make yourself money. My goal is to make a little money on volume, not on ripping people off. But that's also interesting. Like Shift Gold's phones are not ringing off the hook. I mean, it's slow, and that's the same throughout the industry. And what the Shift Gold guys have been telling me, our reps, is that customers have been reluctant to buy because they're worried about buying the high. And I've been telling our customers all year, you got to buy the high because that's all that you're going to have the opportunity to do. The problem is the longer you wait, the higher the high is going to be. So you just might as well buy now. I mean, because you're not going to get a big enough pullback. You'll get some pullbacks, but why wait? It's not going to be enough to make a big difference. And the risk is that by the time you get a pullback, it's pulling back from a price that's much higher than if you just bought it right now. I don't see any panic to buy. Gold's not moving up $100, $200 a day. I mean, that's going to happen. I mean, it moves up $10, $20. I mean, today, $50 is a big move because we got data. But, I haven't seen anything crazy. The gold stocks go up 2%, 3%, maybe 4% in a day. Then they pull back. They're not up 10% in a day. They will be eventually, but we're not there yet. So, people should get on board on the mining, on the metal at Shift Gold. And gold stocks, my gold fund, I'm very partial to my gold fund that's managed by Adrian Day. But I think that the hidden value in my gold fund is our portfolio of very small junior miners that would be almost impossible to buy today, given the liquidity. But these stocks haven't moved the way the big ones have, because the money that has been flowing in has been buying the Newmonts and the Barracks and the Agnico Eagles and the Franco-Nevadas and Kinross and I Am Gold. I mean, they're not buying the little ones.
Peter Schiff's outlook underscores that gold and silver remain deeply undervalued in the current environment. With central banks diversifying away from the dollar, inflation eroding purchasing power, and precious metals poised for technical breakouts, he believes now is the time to accumulate gold, silver, and mining stocks before Wall Street and the broader public catch on. Do you think silver will finally break its decades-old $50 ceiling in this cycle? Will gold's rise to potential new highs force central banks to accelerate their shift away from the US dollar? Share your thoughts on Peter Schiff's analysis in the comments section below. If you find this video informative, please consider supporting us and turning on notifications to stay updated about our latest videos. See you in the following video. Thanks for watching.